Most people focus on the returns, the length of an investment, and the risk when evaluating investment opportunity, which is perfect. But do you understand the risks? And more importantly, are you okay with them? Hi, I'm Greg Butcher with BluSky Equity Partners. And today I want to share with you 6 must-know risks of investing in real estate syndication. The elephant in the room with any investment is that it comes with risk. And with every investment that we go into, we work hard to mitigate those risks, which is what I want to talk about today. Understand, these aren't necessarily risks to whether the deal meets its projections or not. We'll cover those in another video. These are risks from a passive investor's perspective. Risk number one. This is the biggest one people think about, the risk of losing your money. You could invest, say, $50,000, and if a bunch of things go wrong, hey, you could lose some or even all of that money. It sounds awful, but I want you to know there's a very real risk, just like it is in any investment, whether real estate, cryptocurrency, or the stock market. So here's how I mitigate that risk. One, we put in place an experienced team who's done this before and who has a strong track record. Two, we buy an asset that's cash flowing right out of the gate. We invest in growing markets. We utilize conservative underwriting that gives us a buffer in case things go wrong. And we always advise our investors to invest in cash or retirement funds they have and not to take out a loan. This is just the short list, but those are all things we do to help mitigate or curb risk number one, losing your money. Now, risk number two is that we can't keep to the budgets or timelines we set. The budgets and timelines are estimated projections based on data. And let's be real, those estimates could be off. I think we've all heard a story of renovations that went horribly wrong or took much longer than planned, or they peeled up the floorboards and found things they did not expect. That can absolutely happen. However, here's how we mitigate that risk. Again, I'm going to emphasize that we try to put in place experienced teams who have done this before and who do the due diligence. We do a very detailed inspection and we work very closely with experienced property management teams to take a look at the business plan and plan out the renovations beforehand. And they actually go and talk to reputable vendors and get those quotes up front. Another thing we do is raise all the funds for the renovations up front. We don't rely on the cash flow to fund them. Risk number three is the risk of a recession or some sort of correction in the market. And that's also a very real risk. Let me tell you how we mitigate that. Again, having an experienced team is important. If anything goes wrong, that team is going to make the right decisions on your behalf. The second thing we do is use a loan that has a buffer. Essentially, this means that our loan terms allow us the flexibility to hold the asset longer than we planned to if necessary. As an example, if we projected a 5-year hold, but at the 5-year mark, the market is soft, our loan might actually have a 7 or 10 year term. So we have flexibility and can hold the asset longer until the market recovers without having to sell or refinance at a bad time. The third thing that mitigates the risk of a market recession is cash flow. We buy assets that are cash flowing right up front. If a recession happens, then if necessary, we don't have to do the renovations. We can just hold the asset as is and know it will still continue to cash flow and cover expenses. All right, the fourth risk is that you as a passive investor might feel like you're left in the dark. Has this thought ever crossed your mind? I mean, for me, when I invest passively, this is nearly as scary as potentially losing my money because I want to know what's going on with my investment. This is absolutely a concerning risk, and here's how we mitigate it. Again, we go back to investing with people who have a tried and true track record, who have done this before successfully, and with whom you can ask for references. You want to talk to others who are invested in their deals as a way of performing your own due diligence. You can ask them for examples of communications they've sent out to their investors to see how detailed their communications are. Personally, we believe it's better to over communicate than under communicate. The next risk is that you might need to withdraw your capital before the hold period is complete. Investing in a syndication is a long term thing. So if you lose your job, you have a parent that gets sick, or any number of other unpredictable things occur during the 5 to 7 year hold, you might need your money back. Now, this is a very real risk that holds some people back just because the events of the next 5 to 7 years are simply unknown. Now, there's not much we can do to mitigate that risk for you, but there are things that you can do yourself. We advise our investors to always have a reserve or emergency fund. If you're thinking about investing $50,000 and that's nearly all the money you have, then absolutely do not invest it with us. Hold on to that money and save more before you invest. You always want to have financial runway in case something unexpected comes up. The common wisdom is to have at least 3 to 6 months worth of expenses. When you have other accounts that earmarked for emergencies and upcoming expenses, in addition to your investing funds, then you can invest confidently, knowing you won't need to tap into the money that's in the investment because it's illiquid. You have other reserves set aside for those purposes. The last risk I wanted to bring up is one that people often don't think about. And that's the question, what if a better investment opportunity comes up? You might invest in a syndication today, but then in 3 months, you run across some other opportunity and say, dang it, I wish I'd held on to those funds so I could put those funds into this investment. Now, this is absolutely a possibility. There are all kinds of opportunities around every corner, and you're learning about new opportunities all the time, just like we are. To mitigate this risk, the most obvious suggestion is to always retain some additional funds that you can invest. So, again, don't invest with the last dollar in your pocket. Always have extra you can put into other great opportunities when they arise. Second, and this is perhaps the biggest thing across the board, is to always invest based on your personal goals. You should evaluate every investment opportunity on your personal investing goals. And if an investment does align with them, then go for it. If a better opportunity comes along, hey, it might pan out, it might not, but you know the money you have invested is in opportunities that align with your desired investing goals. Now, overall, yes, there are a lot of risks that come with investing in a real estate syndication, just like with any other investment. And it's important for you to be very aware of those risks from the very beginning so you can go in with your eyes wide open. What kind of investing have you done before? If earning rental income or interest off your investments is your thing, I'd love to hear from you in the comments below. If you haven't thought about investing your money in this way, maybe it's time to start. To learn more about real estate syndications and get your investing questions answered, apply to join the BluSky Investor Club today. You'll find the link down below in the description. Come on in and see how syndications might be the key to your financial freedom and living life on your own terms. Before you go, hit the like and subscribe buttons below. While you're listening, did you think of a friend who needs to hear this? If so, share away. I'm Greg with BluSky Equity Partners. Thanks so much for watching.